In the dim glow of trading screens across the globe where fortunes are made and lost in the blink of an eye, most people believe that the price of oil is just another commodity fluctuation, driven by supply chains, geopolitical tensions, or the whims of OPEC decisions. They watch the headlines scroll by: conflicts in the Middle East, sanctions on producers, the slow grind of energy transitions. It's comforting to think it's all contained, a temporary spike that will settle back into the familiar range of $70 to $90 a barrel. After all, we've seen it before. Prices rise, economies adjust, and the world moves on. But while the world fixates on the visible sparks of conflict and policy announcements, the real unraveling is happening in the shadows of the global financial architecture. Oil isn't just fuel, it's the lifeblood of the Petro-Dollar system, the invisible scaffolding that has propped up American economic hegemony for half a century. And now, with Brent crude breaching $150 per barrel, a level not seen since the chaotic days of 2008's financial meltdown, the cracks are widening into fissures. This isn't a mere supply shock, it's the beginning of a death spiral for the dollar's dominance, echoing the 1973 oil crisis, but amplified by decades of accumulated debt, deglobalization, and the quiet rebellion of emerging powers. What if I told you that the true crisis isn't the price at the pump, but the erosion of the very currency that prices it? Picture this. Vast oil fields in the Arabian desert, pipelines snaking through frozen Siberian tundra, and supertankers cutting across stormy seas. These aren't just conduits for black gold, they're arteries in a monetary system built on a fragile promise. Back in 1971, when President Nixon severed the dollar's tie to gold, the U.S. struck a deal with Saudi Arabia. Oil would be priced and sold in dollars, and in return those dollars would flow back into U.S. Treasuries funding deficits and maintaining the greenback's reserve status. It was a masterful stroke of financial engineering, turning a commodity into a currency anchor. For decades, it worked. Petrodollars recycled through Wall Street, keeping interest rates low and the American consumer economy humming. Yet today, as we stand on the precipice of 2026, that system is fraying. Nations like China and Russia are increasingly settling oil trades in yuan and rubles, bypassing the dollar entirely. India barters for discounted crude with rupees, while Brazil and Argentina explore commodity-backed alternatives. The BRICS bloc, once a loose alliance, now whispers of a new reserve currency, perhaps tied to gold or a basket of tangibles. Meanwhile, U.S. debt to GDP ratios hover above 130%, a figure that would have been unthinkable in the post-war era. Central banks, once voracious buyers of treasuries, are diversifying away, selling off dollars to hoard gold at rates not seen since the 1960s. The headlines scream about wars and embargoes, but they miss the monetary shadow. Inflation isn't just rising prices, it's the dilution of trust in fiat systems. When oil hits $150, it's not merely expensive energy, it's a signal that the petrodollar's recycling loop is breaking. Exporters no longer want to hold depreciating dollars. They demand real assets or alternative currencies. This creates a feedback loop. Higher oil prices fuel inflation, which prompts rate hikes, which strengthen the dollar temporarily, but crush emerging markets, leading to more de-dollarization. It's a spiral, slow at first, then accelerating, much like the unnoticed drip that becomes a flood. Consider the everyday implications. In the U.S., trucking companies face fuel costs that double logistics expenses, rippling through supply chains to inflate everything from groceries to electronics. In Europe, already battered by the loss of cheap Russian gas, industries shudder as energy bills become unsustainable. Developing nations, dollar-denominated debtors, watch their currencies plummet, triggering defaults and social unrest. And all the while, the Federal Reserve prints more money to buy its own debt, a maneuver that smells of desperation. This isn't hype, it's the calm observation of systemic fragility. The 1973 crisis, triggered by the Yom Kippur War and the Arab oil embargo, quadrupled prices overnight and ended the Bretton Woods era. Today, we're seeing a similar rhyme, but with higher stakes, a multipolar world where the U.S. no longer holds all the cards. As oil climbs, the dollar's throne wobbles. The question isn't if the spiral continues, but how far it goes before the house of cards tilts. Most assume energy independence, shale oil, renewables, shields the West. But shale production peaks, green transitions lag, and dependence on imported refining capacity persists. The pivot isn't to alternative energy, it's to alternative monies. While pundits debate EV adoption or fracking booms, the real move is in Beijing. In Moscow, where deals are inked in non-dollar terms, eroding the greenback's 60% share of global reserves bit by bit. Pause for a moment on that number, 60%. It was 85% in the 1970s. The decline is gradual, but thresholds matter. When confidence evaporates, it does so suddenly, like a bank run on a global scale. We're not there yet, but $150 oil is the canary in the coal mine, singing a dirge for the petrodollar era. History doesn't repeat itself, but it often rhymes. To understand the quiet erosion unfolding today, we must return to the early 1970s, a time when the world last witnessed a profound rupture in the global monetary order, one triggered not by abstract finance, but by the very commodity that still underpins it, oil. In October 1973, the Yom Kippur War erupted. Arab nations, angered by Western support for Israel, imposed an oil embargo on the United States and its allies. Overnight, the price of crude quadrupled from around $3 per barrel to nearly $12. Gas lines snaked through American cities. Economies staggered under stagflation, inflation paired with stagnation. But the deeper shock was monetary. The embargo exposed the fragility of the Bretton Woods system, already crumbling since President Nixon suspended the dollar's convertibility to gold in 1971. That Nixon shock ended the post-war gold exchange standard, transforming the dollar into pure fiat, backed not by metal but by trust and American power. With the gold link severed, the U.S. needed a new anchor for the dollar's global dominance. Enter the Petro-Dollar agreement. In 1974, Secretary of State Henry Kissinger negotiated a deal with Saudi Arabia. The kingdom would price its oil exclusively in dollars and recycle those petrodollars into U.S. treasuries. Other OPEC nations followed. Suddenly, every country needing oil had to hold dollars, creating inexhaustible demand for the greenback. This recycled wealth funded U.S. deficits, kept interest rates low, and sustained American hegemony. It was a brilliant, unspoken pact. Oil for security, dollars for influence. For decades it held. The system weathered the 1980s debt crises, the 1997 Asian financial meltdown, even the 2008 crash. Petrodollars flowed back to Wall Street, masking growing imbalances. U.S. debt climbed, but foreign buyers, flush with oil revenues, absorbed it. The dollar's share of global reserves peaked above 70%. It seemed unbreakable. Yet rhymes emerge in the strains. Just as the 1971 gold severance created vulnerability exploited by the 1973 embargo, today's accumulated distortions are being laid bare. U.S. public debt now exceeds 120% of GDP, a level higher than post-World War II peaks, sustained only by the dollar's reserve status. Central banks, once reliable buyers of treasuries, have slowed purchases and diversified into gold at unprecedented rates, over 1,000 tons annually in recent years, with emerging markets leading the charge. The parallel is unmistakable. In the 1970s, a commodity shock shattered illusions of permanence. Today, while oil prices hover in the low 60s amid oversupply and geopolitical easing, the underlying monetary shadow lengthens. Nations no longer fully trust the recycling loop. Russia and China settle energy trades in rubles and yuan. India pays for Russian crude in rupees. Even Saudi Arabia, architect of the petrodollar, has explored yuan-denominated deals and deepened ties with BRICS alternatives. The 1973 crisis didn't end the dollar overnight. It initiated a slow unraveling, forcing adaptations that masked deeper weaknesses. We're in a similar interlude now, a calm before the rhyme resolves. The embargo taught that when oil weaponizes, monetary systems fracture. Today, the weapon is subtler. Quiet diversification, bilateral deals bypassing SWIFT, and a growing preference for tangible assets over fiat promises. Pause on this. In 1973, the world adapted to $12 oil and a post-gold dollar. By 1979, another shock pushed prices to $40, contributing to Volcker's brutal rate hikes and a decade of turmoil. The lesson? Crises don't announce themselves with fanfare. They build in the shadows, where trust erodes incrementally until thresholds tip. What happened then mirrors what stirs now, not in explosive spikes, but in the steady drip of alternatives. The petrodollar didn't die in 1973. It was wounded. Today, the wound reopens, wider and in a more multipolar world. Beneath the surface of daily market fluctuations lies the intricate machinery of the petrodollar system, a mechanism as elegant in its design as it is precarious in its execution. Imagine the global economy as a vast dam holding back the pressures of trade, debt, and currency flows. For 50 years, the petrodollar has been the keystone, channeling the immense volume of oil transactions into perpetual demand for U.S. dollars. But now, leaks are forming, slow and insidious, threatening to undermine the entire structure. At its core, the mechanism is simple, yet profound. Oil exporters, led by Saudi Arabia and OPEC, sell their crude exclusively, or nearly so, in dollars. This forces every importing nation to accumulate dollars, either through trade surpluses or borrowing. Those dollars then recycle back. Exporters invest surpluses in U.S. treasuries, funding American deficits, while keeping borrowing costs low. It's a closed loop, a monetary shadow that has allowed the U.S. to run persistent trade deficits without immediate consequence. Debt accumulates, now exceeding $36 trillion, with a debt-to-GDP ratio hovering around 120%, but the system absorbs it, as foreign holders have few alternatives. This recycling is the hidden engine. Without it, the dollar would face constant downward pressure from America's chronic imbalances. Interest rates would rise to attract capital, squeezing growth. Instead, petrodollars provide a steady inflow, suppressing yields and enabling fiscal expansion. It's no exaggeration to say this arrangement has underwritten American hegemony, turning a fiat currency, unbacked since 1971, into the world's indispensable reserve. Yet the mechanism is breaking down through a series of interconnected failures. First, trust in the dollar's stability is eroding. As U.S. debt swells and deficits persist, exporters question the wisdom of holding ever-depreciating paper. Central banks, traditionally voracious buyers of treasuries, have slowed acquisitions and pivoted to gold, purchasing over 1,000 tons annually in recent years, a pace sustained into 2025. This diversification isn't speculative, it's strategic, a hedge against fiat dilution and geopolitical weaponization of the financial system. Second, alternative settlement channels are emerging. Bilateral trades bypass the dollar. Russia sells oil to China in yuan, India pays in rupees for discounted Russian crude, and even Gulf producers experiment with non-dollar deals. These aren't isolated, they're part of a broader shift in BRICS nations and beyond, facilitated by systems like China's CIPS and growing local currency agreements. The loop phrase is petrodollars no longer automatically return home. Consider the feedback effects, like cracks propagating through that dam. Reduced dollar demand weakens the currency over time, importing inflation through higher energy costs. Ironic, given oil's role. To combat this, the Federal Reserve raises rates, strengthening the dollar temporarily, but burdening emerging markets with dollar-denominated debt. Those nations, facing currency crises, accelerate de-dollarization, selling treasuries and buying tangibles. It's a slow-motion spiral. Less recycling begets higher U.S. borrowing costs, more debt issuance, further erosion of confidence. Metaphors aside, the numbers tell the story plainly. The dollar's share of global reserves has declined from peaks above 70% to around 58-60% today, with gold and alternatives filling the gap. Central bank gold holdings now rival or exceed U.S. Treasury exposures in some portfolios, a quiet revolution in reserve management. Meanwhile, oil trades in non-dollar terms, though still a minority, grow steadily, chipping away at the mechanism's foundation. This isn't collapse, it's entropy. The system sustains on inertia, but thresholds loom. When enough exporters prefer real assets or rival currencies, the recycling halts abruptly, forcing a reckoning. Higher rates, forced austerity, or overt monetization, each with systemic consequences. In the shadows, away from headline volatility, this monetary unraveling proceeds deliberately. The petrodollar isn't dying from a single blow, it's succumbing to cumulative strain, the weight of decades of imbalances finally telling. Now, as we connect the threads of history and mechanism to the present moment, the revelation emerges not in thunderous headlines, but in the quiet accumulation of data points that few choose to scrutinize. The petrodollar system, forged in the fires of 1970s crises, has sustained an unprecedented era of American fiscal latitude. Yet, in late 2025, with Brent crude lingering stubbornly around $60 or $62 per barrel amid oversupply and subdued demand, the underlying fragility reveals itself. Not through explosive price surges, but through the steady, inexorable shift away from dollar dependence. Consider the current landscape. Geopolitical tensions flicker, sanctions on Venezuelan tankers, tightened measures against Russian energy, but they fail to ignite sustained rallies in oil prices. Markets shrug, buoyed by ample inventories and slowing global growth. This low-price environment might seem benign, a relief at the pump and a boon for importers. But in the monetary shadow, it accelerates the unraveling. Exporters, earning fewer dollars per barrel, question the value of recycling those diminished surpluses into U.S. treasuries. Why hoard a currency tied to a nation whose public debt now approaches 120% of GDP, with interest payments consuming ever larger slices of the federal budget? The revelation ties directly to recent developments. Central banks continue their diversification at a measured pace. Gold purchases remain elevated, though slower than the record 1,000 plus tons annually seen in prior years, with emerging markets leading the charge. The dollar's share of global reserves hovers around 57%, down incrementally but persistently from peaks above 70%. Non-dollar oil trades, once marginal, gain traction. India settling Russian crude in rupees, China expanding yuan-denominated deals, BRICS nations deepening local currency agreements. These are not abrupt ruptures. They are deliberate steps in a multipolar reordering. The stakes are profound, particularly for those holding dollar-denominated assets. If this trend persists, and the mechanism suggests it will, the recycling loop weakens further. Reduced foreign demand for treasuries pushes U.S. borrowing costs higher, even as the Federal Reserve navigates rate cuts amid softening inflation. Higher yields attract capital short-term but compound debt servicing burdens long-term, potentially crowding out productive investment. For the average holder of savings, retirement funds, or dollar-based investments, this manifests as eroded purchasing power. Imported goods cost more as the dollar softens gradually. Wealth in fiat form dilutes without fanfare. In emerging markets, the effects ripple outward. Currencies stabilize against local trade partners, but face volatility against a waning greenback. Tangible assets, from gold to commodities, become preferred hedges as trust in pure fiat wanes. The 1973 mirror reflects here. That crisis birthed the Petro-Dollar pact amid chaos. Today's quieter shifts may quietly enter it, without the drama of embargoes, but with the weight of accumulated imbalances. Pause on the implications. A world less tethered to the dollar is one of greater fragmentation. Trade efficiencies erode slightly, transaction costs rise in a patchwork of currencies. Yet it also fosters resilience, reducing vulnerability to unilateral sanctions or policy whims from any single hegemon. For assets tied to the old order, U.S. bonds, dollar cash equivalents, the path ahead grows uncertain, subject to the slow grind of confidence erosion. This is the revelation. The petrodollar death spiral isn't heralded by $150 oil, but by its absence, by a system quietly losing cohesion in an era of abundance rather than scarcity. The headlines distract with surface volatility. The shadow reveals the deeper transformation. In the end, the truth is neither cataclysmic nor conspiratorial. It is the quiet persistence of systemic change in a world no longer content with unipolar monetary hegemony. The petrodollar system, that masterful arrangement born from the ashes of Bretton Woods in the 1973 crisis, has endured for decades by recycling oil revenues into dollar demand, sustaining American deficits and global stability alike. Yet, as we observe in late 2025, with Brent crude trading around $61 per barrel amid abundant supply and tempered demand, the foundations shift not through dramatic rupture, but through deliberate diversification. The dollar's share of global reserves lingers near 57 to 58%, a gradual decline from its peaks, while central banks continue to acquire gold, on pace for another year of substantial purchases, though moderated from prior records. Non-dollar oil settlements expand incrementally. Yuan for Chinese imports, rupees for Indian deals, local currencies within BRICS corridors. The bloc itself advances pragmatic tools, a blockchain-based payment platform explorations of a unit for trade settlement backed partly by gold and member currencies, prioritizing reduced friction over outright replacement. This is the essence of the petrodollar's slow fade. Not a death spiral triggered by soaring prices, but a measured transition amid low energy costs that diminish the urgency of dollar recycling. Exporters, earning less per barrel, seek alternatives. Importers build parallel systems. The mechanism frays without fanfare, echoing the 1970s rhyme in a multipolar key, higher stakes, slower tempo. For those holding dollar-centric assets, the perspective is one of vigilance. Purchasing power erodes incrementally as confidence disperses. Tangible stores like gold gain favor in official vaults, and fragmentation introduces new frictions to global flows. No sudden collapse looms, but thresholds matter. Cross one, and adjustments accelerate. The wise do not predict the end. They observe the shadow lengthening alongside the light. The system is evolving, from fiat hegemony toward a mosaic of alternatives, where trust is redistributed and resilience redefined. The system is changing. Are you watching the light or the shadow? Subscribe to stay ahead of the curve.